Welcome back to another comparison. So today we won't be comparing platforms but asset classes. By the end of this video, you will know the difference between investing in P2P loans versus investing in stocks. My name is Jacob from P2P Empire, and if you are new to this channel and your goal is to become a more educated P2P investor, consider subscribing and hit the like button if you want to see more content like this in the future. We have received quite a few questions from the community, and many of you have been wondering whether P2P loans can yield higher returns than stocks and whether it's safer. In this video, we will explain everything you need to know about investing in stocks and P2P loans so you can make an educated decision when growing or perhaps diversifying your portfolio. So first, I will give you a quick overview of both asset classes, and then we will dive deeper into individual categories to give you a better understanding of the differences between stocks and P2P loans. To get started, you should understand that by investing in stocks, you're investing in the equity of the company. You basically become a shareholder of the firm, which makes you eligible to receive a dividend or benefit from the growth of the company as the price of the stocks increase. This type of investment is called equity investing. By investing in loans, you are investing in claims against the borrower. So you're basically going into a loan contract with the borrower. The borrower repays the principal and the interest, which is your profit. We call this type of investing debt-based crowdfunding. So now that you have an idea about the biggest differences between stocks and P2P loans, let's give you a quick overview of the main characteristics of both asset classes. So as an investor, you are likely interested to learn about the actual return of stocks and P2P loans. By investing in stocks, you can expect a return of about 7.5% per year on a long-term basis. What we are talking about here is an investment period of about 20 or more years. On a short-term basis, you can make much more or much less. If you want, you can look up some benchmarks like the S&P 500, for example, to get more details about the returns in individual years. By investing in P2P loans, you can make realistic returns of about 9% per year, but it obviously comes down to the type of loans that you are funding, the default rates, and the tax systems of your country. When it comes to the cash flow when investing in dividend stocks, either directly or indirectly through mutual funds or ETFs, you can earn a dividend which is paid out typically every 3 months. Logically, growth stocks don't pay out any dividends. If you invest in consumer loans, you will receive the loan principal as well as the interest on a monthly basis. This means that the default risk also decreases every month. When investing in business loans, for example, you might receive interest payments every month, every 3 months, or sometimes even at the end of the loan term. The principal amount is also often returned at the end of the loan term, which means that the default risk of the business loans does not decrease over time. In order to start investing in stocks or loans, you don't need much capital. You can literally start investing with as low as €10, so the capital requirements for both asset classes are very low. If you want to invest in any asset class, you should always make your own research and spend some time educating yourself about the risks and how the whole system works. While the entry barrier to start investing in stocks and P2P loans is very small, you should have at least some moderate knowledge of how the capital markets work. P2P lending is also not a rocket science, and you can start investing without much knowledge. We do recommend, however, to at least watch all of our videos here on YouTube and browse through our website to get an overview of how P2P lending works. When it comes to the security of your investments, there are no protection schemes when it comes to trading on the stock market. Within the P2P lending segment, it always comes down to the platform that you are investing in. Some platforms offer buyback guarantees, some platforms offer investments that are secured by mortgage or additional collateral. Fees are obviously also something that you should consider. When it comes to trading, you should compare brokerage fees, which include commission, a custody fee, as well as regulatory fees. If you trade mutual funds or ETFs, you can also look up the total expense ratio to be aware of all of the costs. By investing in loans, you can expect secondary market fees if you happen to sell your investments before the end of the loan term. This is typically between 0.85% and 2% for the sellers. Sometimes you are also charged a withdrawal fee of €1 or €2, and some platforms even don't charge any fees and you can invest for free. A big factor is also the tax that you need to pay on your capital gains. This always depends on your country where you are officially a tax resident. The tax rate for capital gains varies in European countries from 0 to almost 32%. In most cases, you are able to offset capital losses from trading on the stock market against your capital gains, which lowers the taxable amount. That's something you can't always do when investing in loans. In some countries, the interest rate that you will receive from your investments is taxed differently from capital gains, Also, the deduction of losses is not always as straightforward. If the deduction of losses from defaulted loans is allowed, you often need to wait for years until the platform declares the loan as defaulted. You should, however, always inform yourself about the exact rules that apply in your home country before you start investing. So by now, you have a rough idea about some of the differences between stocks and P2P loans, but there is much more that you should be considering. So let's have a look at a few categories and compare stocks and P2P loans against each other. So we have already briefly discussed the returns of both asset classes, but there are a few things that you should be aware of. By investing in stocks, you invest in companies from which you may yield dividends or simply capital gains if the price of the stock increases. The thing is, however, that your return from stocks is not always predictable. There is a chance that you make good money, but there is also a chance that you lose all of it. The potential return cannot be predicted, but it could be well above 20%, which is not something you will experience with P2P loans. By investing in loans, you can make around 11 or 12% per year. Anything above that is not very realistic on a long-term basis. There are investment opportunities that promise a more than annual return of 20%, but the risk of those investments is often much higher than the potential return. The recovery of those loans is typically a very long process, and those platforms that offer those type of investments are usually also not very transparent. The thing you should also consider is that if the loan in which you have invested defaults, chances are that you won't be able to recover the principal amount as well as the interest rate. That's particularly the case if the loan is not secured by any tangible collateral, like a mortgage, for instance. Whereas when the stock market plummets, it may bounce back in some time and you won't suffer any losses. Another very important aspect is the volatility, which basically means unpredictable changes in the stock market. The stock markets are typically volatile, which gives you the chance to make quick wins, but also higher losses. Geopolitical events and financial news have a much bigger impact on the stock market in comparison to the P2P lending loans, which are not considered as a volatile asset class. The return is determined by the time you start investing, and mostly it depends on the ability of the borrower to repay the loan as well as on the ability of the lending company to recover the debt, which makes the return from P2P lending much more predictable in comparison to stocks. Certainly, external factors like newly imposed regulations or a global financial crisis are also impacting the lending business. However, there are lenders that are able to adapt and still create profits for the company as well for the investors. This is also why we recommend studying the company, its management, and its lending practices before you start investing with them. Volatility may not only influence your returns, it can also have an impact on your emotions. Retail investors often experience the fear of missing out, which is why they buy into the hype when it's often too late. A drastic decrease in stock prices may also cause retail investors to exit their positions with losses. These types of emotions are not much experienced by P2P investors, as the expected return is given in advance. The only concern you might have as a P2P investor is to invest in bad loans or in scams. This is, by the way, also something that you can avoid to a large extent by reading over reviews and P2P lending guides on P2P Empire. On the other hand, investing in stocks, especially during bull market, is very exciting, and you will likely enjoy the green arrows pointing out your wins. This is not something you will experience with P2P lending, as this is rather a boring matter. Conducting your initial research, investing and monitoring your P2P portfolio will not necessarily excite you, and it's quite boring actually. So let's move on to the next category, which is the time investment. As with any asset class, you should first educate yourself about how it works before you start investing. By educating, I mean not to watch YouTube videos, but verify information directly with the source. When investing in the stock market, you can either invest in an ETF, which is a more suitable option for passive investors that are looking to invest in a broad portfolio of stocks, or you can pick up your own stocks, which is usually more time-consuming, as you will want to evaluate whether the stock is undervalued or overpriced. Figuring this out can take quite a lot of research, and understanding of the industry is a must if you want to pick your own stocks. Investing in P2P loans also requires some initial time investment, especially when starting out. You should conduct your own due diligence about the platforms and the lending companies in which you will be investing. A good tip is also to think about which type of loans you want to invest in, as this will have a big impact on the safety and the liquidity of your P2P lending portfolio. The initial time investment for a P2P lending is likely higher as when choosing an ETF, but certainly lower as evaluating companies and picking your own stocks. What you should be also considering is the time you need to spend for trading or investing in P2P loans and monitoring your portfolio. Investments in ETFs and P2P loans can be well automated, and the monitoring should not take that much time. Whereas investments in the stock market require more time, as you want to be aware of all the news surrounding your companies in which you have invested, and setting up buying, stop loss and selling orders will also require some time. Before we move on to the next category, we should certainly mention the aspect of liquidity, or in simple terms, the time you need to withdraw your money. The stock market is typically very liquid, and you can exit your positions during market hours and access your cash almost instantly. With P2P lending, the liquidity depends on the loan type in which you are investing, as well as the tools offered by the P2P lending platforms. Some platforms offer investments mainly in short-term loans with a loan term of just 30 days. Other platforms offer a secondary market or a cash-out option that will help you to liquidate your portfolio faster. The liquidity on the stock market is, however, much higher than the liquidity within the P2P lending sector. A hot topic within the P2P lending community is also the aspect of diversification. Many P2P lending platforms that don't have any added value will tell you that you should invest with them because they offer you the chance to invest in thousands of loans from dozens of lending companies in various countries. The aspect of diversification should definitely not be underestimated, but you should diversify across solid assets. Investing in lenders who are over-leveraged and rely to a big extent to the funding from P2P investors is not the most sustainable way, and it can easily backfire, as we have seen on some P2P marketplaces last year. Diversification is important, but even investing in thousands of loans from which 80% are delayed and a huge chunk defaults does not make your investments safer. Instead, think about the underlying assets. How is the loan secured? What's the long term? What are the recovery rates? What's the track record of the loan company? And how does the finance group operate? The diversification of your stock portfolio is much easier. You can simply invest in an ETF that includes dozens or even hundreds of stocks from reputable companies which meet the regulatory requirements and provide all the financials so you're able to evaluate them. Two of the most popular ETFs are MSCI World and MSCI Emerging Markets. If you want, you can simply Google the title of the specific ETFs and look up all the holdings that are included. You can also diversify your portfolio on your own by selecting your stocks based on your preferences. You can add companies from various industries where you believe that the price will increase over time. As you might notice, however, this is a more time-consuming approach. Now, let's talk about the usability of the platforms for a moment. When it comes to trading, you have a broad range of options. You can start with trading apps like Revolut to gather your first experience before you move to an entry-based brokerage company like DeGiro. Investors that require more sophisticated tools will like to end up using brokers like Interactive Brokers. Also, if you plan to invest in ETFs as a savings plan method, you should look up for brokers who are offering this type of service. Investing in P2P loans is much easier. Most of the platforms are quite intuitive and the learning curve is not as steep. After you register and pass the KYC questionnaire, you can top up your account and often start investing the same or the next day. Also, most of the platforms offer you tools to automate your investments as well as to monitor your portfolio. Now, let's talk about the support that you can expect by investing in those two asset classes. When investing in stocks, you should not expect any support. Most brokers will explain to you some of the features of their tools, but most of the data required to make an educated decision, you need to research on your own. When it comes to P2P lending, the P2P lending platforms are usually more inclined to provide additional information about the borrower segment or the lending companies. You will also find the financial reports or statistics which you should always review before you start investing. If you are new to investing, P2P lending platforms will typically provide more education about the asset class as opposed to brokerage firms. So now you might be asking yourself, which of those two asset classes is the better fit for you? Well, both asset classes have their pros and cons, and it comes down to your own investment strategy. In the long term, the stock market outperformed many other investments. If you want to invest short term, investing in P2P loans will give you a predictable return as the volatility of this asset class is much lower in comparison to trading stocks. Since both asset classes don't correlate with each other, it's certainly worth investing in the stock market in the long run, as well as into the P2P loans to bring more stability into your portfolio. I think that it makes a lot of sense to diversify across both asset classes. You will not only help to grow your portfolio, but you will also gain a lot of knowledge about investing, which you won't get anywhere else. A piece of good advice is to treat both asset classes as long-term investments, but also keep in mind the liquidity aspect in case that you need to adjust your investment strategy. So that's been our in-depth comparison between P2P loans and stocks. Let me know whether you invest in both asset classes and which one you prefer in the comments below. If you value the information in this video, leave a like. This will motivate us to create more content like this in the future. So that's been it from me today. Thanks for watching, and I will catch you in the next one.